Question 1. An investor is considering purchasing a municipal bond whose debt service is secured by the revenues generated from a toll road. This type of municipal bond is most accurately described as A. General obligation bond. B. Moral obligation bond. C. Revenue bond. D. Special assessment bond. Answer: C. Revenue bond. A revenue bond is a municipal bond backed by a specific revenue stream, such as tolls from a toll road, fees from a water system, or lease payments from a hospital. Unlike general obligation bonds, which are backed by the full faith, credit, and taxing power of the issuing municipality, revenue bonds rely solely on the income generated by the project they finance. Understanding the source of repayment is crucial for assessing the risk of a municipal bond, as revenue bonds carry a higher risk if the project's income falls short. Remember that revenue directly points to the source of payment for these specific types of municipal bonds. Question 2. The interest income from most municipal bonds is exempt from federal income tax. For an investor residing in the state where the bond was issued, the interest may also be exempt from A. Capital gains taxes. B. State and local income taxes. C. Estate taxes. D. Social security taxes. Answer: B. State and local income taxes. A key feature of municipal bonds is their tax-advantaged status, offering interest income that is typically exempt from federal income tax. For investors who purchase municipal bonds issued within their own state of residence, the interest income also often enjoys exemption from state and local income taxes, providing a significant benefit known as the triple tax exemption. This means the income is not taxed at the federal, state, or local levels, making them particularly attractive to high-net-worth individuals in high-tax states. Always check the tax rules for your specific state and locality, as exemptions can vary. Question 3. Which of the following documents is prepared by the issuer for new municipal bond offerings and serves as the primary disclosure document for potential investors? A. The indenture of trust. B. The official statement. C. The prospectus. D. The legal opinion. Answer: B. The official statement. The official statement is the disclosure document prepared by the issuer for new municipal bond offerings, providing comprehensive information about the bond, the issuer, and the project being financed. It is analogous to a prospectus for corporate securities, detailing the bond's terms, security features, financial condition of the issuer, and any significant risks. Investors should always review the official statement before purchasing a municipal bond to understand its characteristics and make an informed decision. Think of it as the issuer's detailed presentation about the bond issue. Question 4. All of the following are typically considered when analyzing the creditworthiness of a general obligation, bond, except A. The community's overall property values. B. The municipality's outstanding debt and unfunded pension liabilities. C. The project's feasibility study and projected revenue streams. D. The issuer's history of tax collections and budget surpluses. Answer: C. The project's feasibility study and projected revenue streams. When evaluating the creditworthiness of a general obligation, bond, analysts focus on the municipality's ability to tax its residents and its overall financial health, as bonds are backed by the full faith and credit of the issuer. This includes examining property values, existing debt, tax collection history, and budgetary stability. A project's feasibility study and projected revenue streams are primary considerations for revenue bonds, which depend on specific project earnings for repayment, not the general taxing power of the municipality. Remember that bonds are about the issuer's general financial strength, not a specific project's income. Question 5. Which of the following is not a type of revenue bond? A. Industrial Development Revenue, IDR, bonds. B. Lease rental bonds. C. Public Housing Authority, PHA, bonds. D. Library district bonds. Answer: D. Library district bonds. Industrial Development Revenue, IDR, bonds, lease rental bonds, and Public Housing Authority, PHA, bonds are all specific types of revenue bonds, backed by a particular revenue source or lease payment. Library district bonds, however, are typically general obligation, GO, bonds, financed by ad valorem, property, taxes from the general taxing authority of the district, not by revenues generated from the library itself. Distinguishing between the types of municipal bonds is crucial for understanding their security and how they are repaid. If the name sounds like a general service that isn't typically revenue generating, it's likely a GO bond. Question 6. A municipal bond issue where the issuer reserves the right to retire the bonds before their stated maturity date is said to have a put feature, B. Sinking fund provision, C. Call feature, D. Refunding clause. Answer: C. Call feature. A call feature grants the issuer the right to redeem or call a bond back from investors before its scheduled maturity date, typically when interest rates have fallen. This allows the issuer to refinance their debt at a lower rate, similar to how a homeowner might refinance a mortgage. While beneficial for the issuer, a call feature presents reinvestment risk for the bondholder, as they might have to reinvest their principal at a lower yield. Always be aware of call provisions, as they impact a bond's effective maturity and potential return. Question 7. The primary purpose of a municipal bond's legal opinion is to A. Assess the financial feasibility of the project. B. Confirm the bond's tax-exempt status and its legality. C. Provide a rating for the bond's creditworthiness. D. Outline the bond's call and put provisions. Answer: B. Confirm the bond's tax-exempt status and its legality. The legal opinion, typically provided by bond counsel, is a critical component of a municipal bond offering. Its primary purpose is to attest to the bond's legality, validity, and most importantly, its tax-exempt status at the federal level, and potentially at the state and local levels. This opinion assures investors that the interest income they receive will be free from specified taxes. Without a clean legal opinion, a municipal bond issue is unlikely to be marketed successfully to investors. Question 8. When analyzing a municipality's debt burden for a general obligation bond, coterminous debt refers to A. Debt shared with other overlapping taxing authorities within the same geographic boundaries. B. The municipality's total outstanding debt, excluding self-supporting debt. C. Debt incurred solely for specific revenue-generating projects. D. Debt that matures simultaneously with other outstanding bond issues. Answer: A. Debt shared with other overlapping taxing authorities within the same geographic boundaries. Coterminous debt, also known as overlapping debt, refers to the debt that a specific municipality shares with other governmental units that have the power to tax the same residents. For example, a homeowner might pay taxes to a city, a school district, and a county, all of which may have outstanding debt. When evaluating a municipality's overall debt burden for a general obligation bond, considering all layers of debt that its residents are responsible for is crucial for a complete credit analysis. This concept helps paint a full picture of the taxing power and financial commitments affecting residents within a given area. Question 9. Certain municipal bonds, particularly those issued for private purpose projects, may have interest income subject to the alternative minimum tax, AMT. This means that for some high-income investors, A. The bond's interest income will be subject to state and local income taxes. B. The bond's interest income may be included in taxable income for AMT calculations. C. The bond's principal amount is reduced by the amount of AMT. D. The bond cannot be purchased in an IRA account. Answer: B. The bond's interest income may be included in taxable income for AMT calculations. While most municipal bonds offer federally tax-exempt interest, some private-purpose municipal bonds, such as those issued to benefit private corporations, may be subject to the alternative minimum tax, AMT. This means that for high-income investors who are subject to the AMT, the interest income from these specific bonds must be added back into their taxable income when calculating their AMT liability, reducing the bond's overall tax benefit. Always check if a municipal bond is an AMT bond, if you are concerned about your personal tax situation, as it can impact the bond's after-tax yield. Question 10. The MSRB, Municipal Securities Rulemaking Board, primarily regulates A. Municipal issuers and their financial advisors. B. Underwriters, brokers, and dealers of municipal securities. C. Investors purchasing municipal bonds. D. The tax-exempt status of municipal bonds. Answer: B. Underwriters, brokers, and dealers of municipal securities. The MSRB, Municipal Securities Rulemaking Board, is a self-regulatory organization, SRO, that creates rules for municipal securities firms and professionals, including brokers, dealers, and municipal advisors. Its primary role is to protect investors and the public interest by ensuring fair and efficient municipal securities markets. While the MSRB sets rules for firms involved in municipal securities transactions, it does not regulate the municipal issuers themselves or directly impact the tax status of the bonds. Remember that the MSRB's focus is on the conduct of those who sell municipal bonds. Question 11. Which of the following is not an advantage of municipal bonds for an investor? A. Typically exempt from federal income tax. B. Generally considered safe investments. C. High liquidity in the secondary market. D. Potential for state and local tax exemption if issued in the investor's state. Answer: C. High liquidity in the secondary market. While municipal bonds offer attractive tax advantages and are generally considered safe investments due to the backing of governmental entities, they often suffer from lower liquidity in the secondary market compared to other fixed-income securities like treasury bonds or actively traded corporate bonds. The municipal bond market is fragmented, with many different issuers and relatively small issue sizes, which can make it challenging to quickly buy or sell specific bonds without impacting their price. Always consider liquidity, especially for larger positions or when you anticipate needing to sell before maturity. Question 12. A customer receives a confirmation for a municipal bond trade. According to MSRB rules, the confirmation must disclose all of the following except A. The capacity in which the broker-dealer acted, agency or principal. B. The dollar amount of the accrued interest. C. The bond's rating from a nationally recognized statistical rating organization. D. Any commission charged if the firm acted as an agent. Answer: C. The bond's rating from a nationally recognized statistical rating organization. MSRB rules require municipal bond trade confirmations to provide essential information about the transaction, such as the trade date, settlement date, description of the security, price, accrued interest, and the capacity in which the broker-dealer acted, principal or agent, along with any commission if applicable. While a bond's credit rating is crucial information for an investor, MSRB rules do not require it to be disclosed on the confirmation statement itself. This information is typically obtained by the investor through other disclosure documents like the official statement or from a rating agency. Question 13. When comparing a taxable bond to a municipal bond, an investor would calculate the taxable equivalent yield to determine A. The yield on the municipal bond if it were taxable. B. The yield a taxable bond must offer to provide the same after-tax return as a municipal bond. C. The total yield to maturity of the municipal bond. D. The yield after considering all federal, state, and local taxes on a municipal bond. Answer: B. The yield a taxable bond must offer to provide the same after-tax return as a municipal bond. The taxable equivalent yield, FTY, is a calculation used by investors to compare the yield of a tax-exempt municipal bond to that of a taxable bond. It answers the question, what yield would a taxable bond need to offer to provide the same after-tax return as a tax-exempt municipal bond, given my tax bracket? This calculation is vital for investors to make informed decisions and ensure they are maximizing their after-tax income by choosing the most suitable investment. Remember the formula, municipal bond yield / 1, investor's tax bracket. Question 14. Which of the following statements about moral obligation bonds is most accurate? A. They are backed by the full faith and credit of the issuing municipality, with tax revenues. B. They are revenue bonds that are additionally backed by a guarantee from the U.S. government. C. They are municipal bonds for which the state legislature has a moral, but not legal, obligation to appropriate funds to prevent default. D. They are bonds whose interest is always subject to the alternative minimum tax, AMT. Answer. C. They are municipal bonds for which the state legislature has a moral, but not legal, obligation to appropriate funds to prevent default. Moral obligation bonds are a type of municipal bond typically issued by a state agency or authority, for which the state legislature has a moral, but not a legally enforceable, obligation to appropriate funds if the project's revenues are insufficient to cover debt service. This means there's no legally binding pledge of the state's full faith and credit. Investors should recognize that while there's a strong incentive for the state to prevent default to protect its credit rating, there's no legal guarantee of support, making them riskier than full faith and credit bonds. Question 15. A municipal bond that has both a primary revenue source and is also backed by the full faith and credit of the issuing municipality is known as A. Special assessment bond. B. Double-barreled bond. C. Refunding bond. D. Moral obligation bond. Answer. B. Double-barreled bond. A double-barreled bond is a municipal bond that combines characteristics of both revenue bonds and general obligation, GO, bonds. Initially, these bonds are secured by a specific revenue source from a project, similar to a standard revenue bond. However, they also carry a secondary pledge of the issuing municipality's full faith and credit and general taxing power, providing an additional layer of security. This dual backing generally makes them more secure than pure revenue bonds but still less secure than pure GO bonds, offering investors a balance of project-specific revenue and general government support. Question 16. A bond whose debt service is paid by charges to only those who benefit from the improvements, example sidewalks, sewers, is known as A. Leaseback bond. B. Public Housing Authority bond. C. Special assessment bond. D. Certificate of participation. Answer. C. Special assessment bond. A special assessment bond is a type of municipal bond issued to finance public improvements, such as sidewalks, sewers, or street lighting, where the debt service is paid only by the property owners who directly benefit from those specific improvements. Unlike general obligation bonds, which are paid by general tax revenues from the entire community, these bonds are repaid through a special levy or assessment on the benefited properties. This means the bond security is tied directly to the ability and willingness of the property owners to pay those specific charges. Question 17. Which entity would typically issue Public Housing Authority (PHA) bonds? A. The U.S. Treasury Department. B. Local housing authorities. C. Private real estate developers. D. State education departments. Answer. B. Local housing authorities. Public Housing Authority, PHA, bonds are issued by local housing authorities to finance the construction or improvement of public housing projects. These bonds are unique because they are backed by the U.S. government's guarantee, specifically through annual contributions from the Department of Housing and Urban Development, HUD, making them very secure. This federal backing significantly reduces the credit risk, often resulting in high credit ratings, which makes them appealing to investors seeking safety. Question 18. An investor purchasing a municipal bond will likely find details regarding the bond's repayment priority and any protective covenants in the A. Bond Rating Agency Report. B. Official Statement. C. Bond Counsel's Legal Opinion. D. MSRB Rule G-15. Answer: B. Official Statement. The official statement is the comprehensive disclosure document for a municipal bond offering, providing detailed information that is crucial for investors. It includes not only the bond's terms and the issuer's financial condition but also specific details about the bond's repayment priority, flow of funds provisions, especially for revenue bonds, and any protective covenants designed to safeguard bondholders' interests. This document is the definitive source for understanding the specific security and terms of a municipal bond issue. Question 19. A municipal bond issue where the underwriter works directly with the issuer to set the terms and price of the bonds, rather than through competitive bids, is known as A. Competitive underwriting. B. Negotiated underwriting. C. Private placement. D. Best efforts underwriting. Answer: B. Negotiated underwriting. In a negotiated underwriting, a municipal issuer selects a single investment bank or a syndicate to advise on and distribute a new bond issue. The underwriter and issuer negotiate the terms of the offering, including the interest rate, maturity schedule, and public offering price, rather than going through a competitive bidding process. This method is often used for complex issues or when the issuer seeks specific expertise from the underwriter. It allows for a more tailored approach to bringing the bonds to market. Question 20. If a broker-dealer executes a municipal bond trade for a customer and charges a markup, the firm is acting in which capacity? A. Agency. B. Principal. C. Fiduciary. D. Introducing. Answer: B. Principal. When a broker-dealer acts as a principal in a transaction, it means the firm is buying from or selling to its own inventory, taking a position in the security. In this capacity, the firm profits from the difference between its purchase price and sale price, known as a markup, if selling to the customer, or a markdown, if buying from the customer, rather than charging a commission. If a firm charges a commission, it is acting in an agency capacity, facilitating the trade between two parties without taking ownership of the security. Question 21. Which of the following factors would be least relevant when assessing the credit quality of a general obligation, GO, bond? A. The issuer's unemployment rate. B. The debt service coverage ratio. C. The community's tax base and property values. D. The issuer's unfunded pension liabilities. Answer: B. The debt service coverage ratio. The debt service coverage ratio, which compares a project's net revenues to its annual debt service requirements, is a key indicator of credit quality specifically for revenue bonds. This ratio determines how well a project's earnings can cover its bond payments. For general obligation, GO, bonds, which are repaid from general tax revenues, factors like the community's tax base, population trends, unemployment rates, and overall debt burden, including unfunded pension liabilities, are more relevant indicators of the issuer's ability to pay its obligations. Question 22. Which of the following is most relevant when assessing the credit quality of a municipal revenue bond? A. The ad valorem, property, tax rate of the municipality. B. The level of overlapping debt within the municipality. C. The feasibility study and projected earnings of the revenue-generating project. D. The general economic strength and population trends of the issuing municipality. Answer: C. The feasibility study and projected earnings of the revenue-generating project. For municipal revenue bonds, the most critical factor in assessing credit quality is the financial viability of the specific project or enterprise that generates the revenue to pay the bond's debt service. This is determined by a comprehensive feasibility study that analyzes the project's projected earnings, operational expenses, and its ability to consistently generate sufficient revenue. Unlike general obligation bonds, the credit of revenue bonds does not depend on the municipality's general taxing power or overall economic health, but rather on the success of the specific venture. Question 23. A municipal bond resolution or indenture will typically contain all of the following except A. The flow of funds statement for revenue bonds. B. Protective covenants designed to protect bondholders. C. The bond's credit rating. D. Provisions for the appointment of a trustee. Answer: C. The bond's credit rating. The bond resolution, or indenture for revenue bonds, is the legal document that authorizes the issuance of municipal bonds and outlines the rights and obligations of the issuer and bondholders. It includes crucial provisions such as the flow of funds, how revenues are collected and dispersed, protective covenants, and the appointment of a trustee. However, a bond's credit rating is an independent assessment by a rating agency and is not part of the issuer's legal bond resolution itself, although it would be disclosed in the official statement. Question 24. A municipal bond is quoted as 5.5% basis. This means the bond's yield to maturity is A. 5.5%. B. 5.5% of its par value. C. The bond has a coupon rate of 5.5%. D. The bond is trading at a discount of 5.5%. Answer: A. 5.5%. When a municipal bond is quoted on a basis, example 5.5% basis, it refers to the bond's yield to maturity, YTM. This is a common way to quote municipal bonds in the secondary market, especially for callable bonds where other yield calculations can be more complex. The basis quote simplifies the pricing by indicating the overall return an investor can expect if the bond is held until maturity, taking into account both interest payments and any capital gain or loss. This simplifies comparing bonds with different coupons and prices. Question 25. An investor who purchases a municipal bond at a discount in the secondary market and holds it to maturity will find that A. The capital gain from the discount is tax-exempt. B. The capital gain from the discount is taxable as ordinary income. C. The capital gain from the discount is taxable as a long-term capital gain. D. The interest income is always fully taxable. Answer: B. The capital gain from the discount is taxable as ordinary income. When an investor purchases a municipal bond in the secondary market at a discount, a price below par value, and holds it until maturity, the accretion of that discount is generally considered taxable as ordinary income for federal tax purposes. This is known as market discount and is typically recognized annually or at maturity. While the interest income from the bond remains tax-exempt, the portion of the return derived from the bond's price appreciation to par is not. This contrasts with original issue discount, OID, bonds, where the accretion of OID is generally tax-exempt.